Hey, it's Richard with Matthews Wealth Management. We're going to do a market update today just to close out June. So these numbers are as of June 30th of 2020. We're going to go through all the different asset classes. It's very numbers intensive. Again, this is for clients that like to keep up with this month to month and quarter to quarter. So we'll just jump right in and go by asset class. And first thing we're going to look for is just the month of June. So June 1st to June 30th. And we're going to start with U.S. equities. So large cap value actually is the only one that had a negative for the month. So that's kind of interesting. The value stocks are not as valued, down about 1%. Then we get into the large cap core or blend and growth. And you've got the 2.3, 2.6, very normal. Mid cap values to core to growth is actually kind of interesting. There's a little bit of a dip in the core asset class there, but you can see the large cap growth going from 2.6 to mid cap 3.5. That's what we would expect. We'd expect as the market goes up for the smaller and mid cap companies to keep up with that growth. Value in the small cap, kind of a similar scenario there in the small cap value and core. And then growth, we jump up to 4.22. So it was a really good month for mid cap growths and small cap growths. When we look to international, we see that international is kind of recovering, a 3.44 month. Emerging markets did really well, so 7.4%. A lot of that might be just supply chains working themselves out around the globe, but we've got Treasury inflation protected securities, which we call TIPS. We're up 1.12 for the month, which is very high. That's kind of a big notice, a red flag, if you will, about what's coming on the inflation side of things. So 1.12 is high. Short-term bonds, 0.20, intermediate, 0.62, long-term bonds, 1.55. That's a very large jump from these two first bond terms to the long term. That's a big jump in return there. High yields kind of low, actually, right at 1%. Figured that would probably go a little bit higher, but it's positive. More we can say for large cap value, but real estate, good month, 2.76. Oil doing very well in the world of possible recovery from COVID, but 9.59%. Gold is continuing to rise, 2.8. That's an inflationary hedge. And overall, the S&P was up about 2%. And if we were to look at what Dow Jones would consider a moderate portfolio, that would be a 1.98, right on the tails there of the S&P 500, interestingly enough. So that's the month of June. Everything's up for the most part, except for one. Let's go back to the last quarter. And the last quarter starts April 1st. So that was after the big dip from COVID that we started to experience in February and then through March as people started shutting down the states and the economy. This is the recovery, if you will. So these numbers are huge. The first thing I want to highlight is large cap value, positive 12. Then we get to core 19, and then it jumps to 26. So large cap growth, mid cap growth, small cap growth. These growth stocks seem to be what everybody wants to throw their money into lately. And you can see how it ramps up in mid caps from 18, 20, and then jumps to 34. Then we go 21, 20, and then 32. So again, growths are the fun thing to invest in and put your money into. So when people get greedy, it's time to be fearful. That's kind of my take on where we stand now with growth. And that'll be factored into a lot of dollar cost averaging and reallocations that we're going to be doing at Matthews Wealth Management. International and emerging markets are much more aligned, the 15 and 18%. Then we get into the world of bonds, which have not done so great because people are throwing their money in the growth stocks, but 4.24 on TIPS is a good amount for inflation protected securities. Short term 1.1, intermediate 2.8, and then we jump again long term to 6.2. High yield, this is much more in line with what we would have been expecting. As we're looking at the high yield bonds, there's a program that the Federal Reserve is putting into place, buying up high yield bonds and junk bonds and corporates and so forth. So that's a big part of that. It started to taper, as you're seeing in the last month. Real estate up 14.6 on the recovery end after COVID. Oil, let's just call that flat. You'll see what we're coming up with year to date, but 0.7. Gold doing very well, 12%. S&P was 20.5%. Now we start to see the separation from what a moderate bond stock mix portfolio would look like, according to Dow Jones, at only a 13.4 in that same time frame. So year to date, we've got a lot more red in here, and this takes into account the losses that were experienced between the February-March downturn. So the thing that just blatantly stands out is growth is positive and everything else is negative when it comes to the U.S. equities, and especially on the value side. Values have been absolutely hammered. And a lot of that is there's just no revenue for dividends. So what's the point, right? And meanwhile, it's just fashionable now to invest in growth stocks. So they've done well for the year in general. I mean, compared to any other year, that would be great. That would be amazingly well to have large cap, which is typically a sizable portion of an allocation, return 12% halfway through the year. I mean, that's a record year in a crazy economy. So go figure. Let's jump into international, down 11, and emerging markets down only 9.7. That's a little flipped. We would expect it to be opposite. When things sell off, you expect the riskier side of the investment to do worse. So that's not the case here. But then we get into the world of bonds. TIPS at 6, so on pace for a 12% year. Short-term bonds right at 3, then 5, then 12. So again, a huge jump on the long-term bonds, and a lot of that's just bonds aren't paying interest anymore, and people want the old stuff that used to pay. Even 3% is considered good nowadays. So high yields are negative. A lot of that is just the credit risk. People sold off a lot of those in the dip, and you see a lot of the buying has started again, but not quite enough to come back to zero. Real estate is still down 13.8%, and oil still down 66.6%. Great number, right? But oil is struggling to kind of find its footing as we restart the economy. Gold continues to hold strong, a big inflation hedge. It's where people go during panics and to avoid downturns in the market. S&P is down 3% on the year, and the Dow Jones Moderate is down 3.66. So that's interesting to see a lower risk portfolio underperform what we would consider pretty much full risk, being in the S&P 500. So let's go to the overarching practice numbers. I did this last month just to kind of show we do have some short-term investing strategies with clients to take advantage of the dip in COVID. So the best short-term, we're up 45.81. That's a year-to-date number, so from January 1. And then the best long-term is up 12.67%. The worst one, which is pretty speculative, had an interesting buying in time, but the worst one is a negative 12.15. And the entire practice average year to date, we are down 2.59%. My clients predominantly are retirees or retiring, or they're business owners. So we kind of run the whole gambit there. But to be negative 2.59, you compare that back to where we are with moderate in the world. We've preserved capital, preserved buying power. So that's the goal. That's what we do with modern portfolio theory and taking advantage of some tactical opportunities post-COVID. But things are interesting. We'll see what happens. I think when July 15th, I think this unemployment $600 per week stipend ends, and we'll see some people have to start selling shares to make ends meet. So I'm expecting a pretty big turnaround in July, probably the later half of July, but we'll see what that looks like in our next video for market update, and stick around. We'll see you then.